All right, we're moving on to what is the time value of money, number 13. You'll notice I've referenced a video here that I produced with regards to the time value of money and what it means. So I'm going to leave you to watch that video because if you don't watch that video, I have to do the whole video here and I don't want to do that. So watch that video to better understand what the time value of money really means. And please don't tell me that the time value of money means money tomorrow means more, sorry, is worth more than money today. So my question is, why is that true? And that's the answer you're going to get from the video. Okay, so calculate the present value of a single sum and the present value of an annuity. So in order to deal with the time value of money, you have to be able to do present value. And so I want to make sure you understand how to do that. I particularly want you to be able to do that in the context of accounting using time value tables, or sorry, present value tables. So notice at the end of this package, I've now added present value tables, which are straight from the textbook. And I've got a copy here. Where is my copy here? There we go. There's present value tables. Just going to move them up just a little bit so we can see more of them. Okay, so we're going to be using these, and keep in mind they're at the end of the package, but they're also in the textbook. I believe on page number 521 and 522. Yeah, 521 and 522 of your textbook, but I've got them here so we can reference them. All right, assume you will receive $100,000 in 2 years' time and that the market rate is 7%. So when we're looking at time value of money, we always look at the market rate. And so that's why we need the market rate. The market rate is the rate for which you could invest money, or somebody, sorry, I said you, but somebody can invest money, and this is the return they would make, 7%. What is the present value of $100,000? So how do we calculate the present value of one single amount being received in 2 years' time? So if we look at a timeline, wait 1 second. So if I look at a timeline right now, I've got nothing right now. Come on. I've got nothing right now, so I have $0 today. Okay? But in 2 years' time, I'm going to get $100,000. And what I want to say to myself is, if I could get that money today, if I could get cash today, that would buy me the same basket of goods. So here's my basket of goods. If I wanted to buy the same basket of goods, the exact same basket of goods, same size, same basket, same size. How much money would I need today? What is this fictitious amount that I would need today in order to buy the exact same? And I know my baskets look bigger. Oh, okay, you know what? There. I think they look more similar now. So I want to buy the same basket of the same size today. I know what basket I can buy in 2 years' time. How much money would I need today to buy the same basket? Because my purchasing power is stronger now, today, than it is in 2 years' time. And again, watch the video so you understand why. So what I want to know is, what is the present value of $100,000 today? So I need to know two pieces of information: the number of periods that have passed, which in this case is 2, because that stands for years. And I need to know the market interest rate. So the market interest rate here is 7%. So remember, when we're dealing with time value of money, we want the market interest rate. All right. So we know those two pieces of information. It's 2 periods and 7%. So I need to take the $100,000 and I need to multiply it times a factor. And this factor right here, I'm going to get from the present value tables. Now there are two present value tables. One is the present value of $1. So this is the present value of a single sum. Wait 1 second. It's a present value of a single sum, which we will receive in the future. Receive or pay actually in the future. Well, that's exactly what's going to happen, right? That $100,000 I'm going to receive in 2 years' time. So remember I said periods are 2. Interest rate is 7%. Well, look at the top here. 1.5, 1. Yeah, 2. No, no, no. I don't have 7. Ooh, let's go down. There we go. There's my 7% interest. And remember, I need 2 periods. So if I go, then this is the number I need. That's my factor. 0.8734. 8734. That's the factor I need. So if I go back here, I'm going to be able to do the calculation. I'm going to multiply it times 0.87, and I said 34. If I multiply that out, it's $87,340. So the present value of $100,000 in the future is $87,340. So if I wanted to buy this same basket of goods today, I wouldn't need $100,000. I would only need $87,340 to buy the exact same basket of goods, because each dollar that I hold in my hand, what's called a nominal dollar, it's worth more. It buys more, right? It's buying more than it will buy in 2 years' time. So notice that the present value of a future sum is always smaller than the future sum because I have higher purchasing power in this current period. Okay, so that's the present value of a single sum. What about the present value of an annuity? Well, I did this calculation when Grace VanderWaal won America's Got Talent, which would have been in 2000, and I think she won in 2017. Anyway, so Grace VanderWaal was, I don't know, 11 years old, 10 years old, something ridiculous like that. And I was like, oh my God, she got $1 million. And then you read the fine print and discover that she's going to get $1 million over 40 years. And if you take $1 million and divide it by 40 years, turns out she's going to get she's going to get $25,000 a year at the end of every year for 40 years. So I'm thinking to myself, well, what is that worth? Because we know, because of the time value of money, that money in the future will not buy you the same amount as money will today. So if I drew out a timeline for this whole thing, right, this is 40 years in the future. And at that time, by the way, she's going to get 25,000 in that year. This is today. Okay, she's getting 0, but she's going to get 25,000 here and here and here, right? At the end of every single year, she's going to get $25,000. If I look, I have to draw this 40 times. I'm not counting, people. Okay, I probably have not written it 40 times, but let's just assume that she's receiving $25,000 every single day. Well, if she said to them, listen, I want all the money right now. They're like, no, I'm not going to give you $1 million because you're not actually going to get $1 million of buying power. You're going to get less than $1 million of buying power because even in 1 year time, the $25,000 I give you in a year, it's not going to buy the same amount of goods that it would today because of inflation and opportunity costs. So you're giving up some value and you're waiting over time. So what would the present value of 40 $25,000 payments over the next 40 years look like? And so we have to do the present value of an annuity. And let's just be clear, what does the word annuity mean? Annuity is a fixed sum of money paid every year for the rest of someone's life, right? Well, in this case, it's for 40 years, right? And so we already saw present value of a single sum is lower. Don't you think that the present value of $25,000 received over 40 years is going to be low? But it's going to be an annuity. I've got to take that into account. So I'm going to take the 25,000. So you take the payment amount. Okay. And you multiply it times the annuity factor. So let's go over here. This is the present value of a single sum, but I want the present value of an annuity. So here is the present value of an annuity of $1. So again, don't forget, we need to have the two pieces of information I need, because without those two pieces of information, it's useless. So I need P, which is the number of periods, and we already know how many periods there's going to be. There's going to be 40 years of periods. And I, well, in the question, wait 1 second, go back. In this question, it says assume the market interest rate is 7%. So we're still dealing with the 7% here. So let's look at 7%. So I equals 7%. So I don't have 7% here, so I'm going to have to go down. Yeah, here's my 7%. And I need to go down in the periods all the way down until it hits 40. So if I go along 40, and then I go, whoop, where is it? Up here till 7%, then I know this is the factor, 13.3317. That's what the factor is. That's going to tell me the present value. So let's do that. So the factor we said was 13.3317. What does that equal? Well, $333,292.50. So if Grace Vanderwall wanted to get all her money right now, she would only get $333,292.50. That's because the $25,000 over 40 years doesn't have the same amount of purchasing power, because you're getting money in the future. And when you accept money in the future, the purchasing power is decreased because of inflation. So yeah. Notice we've totally ignored the $1 million, because we are never going to receive the $1 million. Whenever we do present value, we do the present value of all the future cash flows that we expect to receive. We're never going to receive $1 million, not in one payment. We're receiving $25,000 every single year. And that's why we pay attention to 25 and we totally ignore the 1 million. All right, so hopefully you have a better understanding of present value and the time value of money. Let's move on. How does the time value of money and the calculation of the present value tie into long-term notes payable and bonds payable? Let's say that I owe somebody, oops, wait. Let's say I owe somebody $100,000 in 2 years' time. So if I owe them in 2 years' time, is the value of that debt equal to $100,000? And the answer is it depends. So the reason, the tie-in to all of this is both notes payable and bonds payable require an outflow. So this is an outflow in the future. And I know that the outflow I have in the future doesn't necessarily in nominal dollars, right? In actual number of bills. It's not going to equal. I don't put $100,000 down here in today because I don't know that I owe $100,000 in the same purchasing power. And so that's what the tie-in is. We know from doing the present value of a future cash flow that the dollars we get today may not be equal to the same amount as the dollars for tomorrow. This has to be reflected on our financial statements because our liabilities must be equal to the amount owed in today's dollars. So this is why we have to use present value to value our non-current liabilities, because our non-current liabilities recorded in today's financial statements may not equal the $100,000 that I'm actually going to fork out in the future. And how is this determined? Well, it's based on the market rate. So based on market rate. Okay, so this is the tie-in. I need to understand present value and the time value of money, because if I don't, I cannot appropriately record my liabilities, my non-current liabilities. All right, let's go down. What are the benefits and drawbacks of financing using notes payable and bonds payable? Well, there's a few good things and then there's a few bad things. So let's look at the benefits first. So no dilution of ownership. So let's see what that means. When you're looking at equity, you're looking at shareholders. And if you issue more equity, increase issue of shares, well then more shareholders. Each owning a smaller slice of the pie. Think about it this way. Let's draw a little pie right here. If there are only two owners in the company, they both own 50%. But now add two new owners. Oh, now this person owns 25. This person owns 25, this person owns 25, this person owns 25. That's called dilution of ownership. You're diluting or watering down the ownership portion that each shareholder owns. If you issue more shares, if you issue more shares to more shareholders, there's a dilution. But, let's go back to this. Two owners, 50%. 50%. Now I issue debt. Any impact on the ownership? Nada. So that's what they mean when they say no dilution of ownership, right? The owners still own the same percentage before and after the debt was issued. No impact. Okay. So, second thing. Interest is an expense on the income statement, right? So it's tax deductible. So think about it. If I have revenue of 270,000 and I have expenses of 250,000, then I have to pay taxes on $20,000. But if I take on some debt and now my revenue is still 270,000, but my expenses are now 255,000, now look at this. I'm only paying taxes on 15,000. So if I multiply this times 20% and I multiply this times 20%, wait for it, because I need a calculator to do that because my head is still sick from my influenza. Yay for me. Multiplied times 0.2. This is 4,000. So this is what I'm going to pay in taxes, right? 15,000 times 20%. This is only 3,000. So it's tax deductible. I can deduct it for tax purposes and it reduces my tax liability to the government, right? So, like, why would that be good about debt, that it's tax deductible? Well, dividends are not tax deductible. So if I issue shares, so dividends paid on shares is not tax deductible. If you remember from past chapters, dividends goes on to the statement of changes in equity, also called the statement of shareholders' equity, right? It goes on the statement of shareholders' equity and it goes after taxes. So here, no tax deductibility. So it's more expensive to have dividends on shares than it is to have interest on debt. So this is a benefit because it is tax deductible. So if we had shares, there would be no benefit. Sorry, if we were paying dividends on shares, there would be no benefit. Number 3. Our belief is when we borrow money borrowed at a low rate of interest will be invested and generate higher returns. So let's see. So we're going to borrow money at 7%, but we're going to invest it and we're going to make 10%. So this is my negative, this is my positive. Well, that's a 3% positive, right? So the belief is when I get money, it's going to increase my revenue, increase my profitability, and create higher returns for the shareholders, right? Because my returns are going to be greater than my cost of capital, and therefore I'm going to have an overall benefit. So what is bad? Because there's bad things too. So what are the drawbacks? Oops. Because there are drawbacks. 1, debt and interest on debt. They must be paid. But that's not true when we sell equity, right? If we sell shares versus sell shares. Well, when we sell shares, the equity and the dividends, they do not need to be paid. I'm going to put often. Depends what kind of shares you sell, but often do not need to be paid. Right? So debt and interest on debt, that has to be paid, even if cash flow is low. Doesn't matter what your circumstances are, you have to pay it. And because of that, it increases the risk of bankruptcy. Right? It makes it more risky for the company to exist. When you have debt, it's riskier because you have to pay the debt and you have to pay the interest on the debt. Because the debt, the total amount of debt has to be repaid at the end of at the maturity date, right? Shareholders' equity never has to be paid. We don't give money back to the shareholders unless we want to, often. And second thing, That's a drawback. Both the, oh, I know, interest payments is a cash outflow. So there's less cash to manage your business because it's going to flow out, right? So, and the principle is the same. There's going to be an outflow of cash. So it's not just that we have to pay it back. When we pay it back, we're taking cash flow and we're removing it from our business. And that means that cash flow is no longer available for us to run our business. And that may make it more difficult for us to run our business. So, because of this constant cash outflow for interest, and then eventually for the principal, it's going to be harder for us to run our business because we may not have the cash that we need to run the business. So, there are good things and bad things about debt, and you have to keep both of them in mind, especially if we're doing a comparison between borrowing money from debt holders and borrowing money by selling shares. And we're not even, okay, I'll correct that. We're not even borrowing money when we sell shares. We're literally getting permanent money, which we never have to pay dividends on, mostly, often. All right, let's move on. Demonstrate the entries for a long-term note payable under the following scenarios. A, principal paid at maturity. So we pay principal at maturity. We don't pay principal consistently throughout. A fixed principal payments, and C, blended principal and interest payments. The market rate is 7%. Okay, so on January 1st, 2018, Magenta Inc. borrows $120,000 from the bank for a 5-year period at 7% interest. Oh, look, the market rate is 7% and the interest rate on the loan is 7%. So that means that this is a par value note payable. No time value of money kicks in. So that's why the market rate is 7%. We don't want to deal with time value of money on top of learning how to record the different types of ways that a company can borrow money. Magenta pays interest annually December 31st and pays the principal at maturity on December 31st, 2021. So now mostly we would pay interest monthly, but I don't want to do that because you can imagine that if we pay interest monthly, it's going to be insane. We're going to do 12 entries for 5 years. No, I'm not going to do that. So that's why I made the interest payable on an annual basis. Provide the entries on January 1st and December 31st, 2018. Note that the entry on December 31st will be repeated every year for 4 years. Also provide the entry on December 31st, 2022. I actually think I'm going to do all the entries because if I do all the entries, it'll be a lot easier. So don't forget, we're going to borrow this $120,000. We're going to pay interest annually, but we're not going to pay any of the principal until the maturity date. So this is a principal paid at maturity. And this is a par note payable, meaning that the market interest rate, which is right here, wait 1 second. Yeah, the market interest rate is 7% and the loan interest rate is 7%. So this is a par note payable. No time value of money. We're just looking at how can we pay loans. And there are 3 ways that we could pay a loan. So we could borrow the money and we actually don't pay anything except for interest. So what happens on January 1st, 2018? What do we get? We get cash of $120,000. And what do we give away? We give away a note payable. $120,000. Now remember, we're not making monthly payments, we're making annual payments. So nothing happens for all these months. We fast forward to December 31st, 2018, and we're actually going to pay the interest on this loan. And the interest on this loan is 120,000. Oops, trying to do a comma there. Multiply times 7% annual interest rate. So annually we will pay $8,400. So this is going to be a debit to interest expense because we've had the use of somebody else's money for a whole year, and credit cash because we're going to hand over cold hard cash, and it's going to be $8,400. So notice we've paid none of the $120,000. The $120,000 is still 100% outstanding. All right, let's go to December 31st, 2019. What's going to happen? Well, we've had the $120,000 outstanding since January 1st, 2019 to December 31st, 2019. Guess what? That's a year. Boom, $8,400. So again, this is going to be a debit to interest expense for the $8,400 and a credit to cash for the $8,400. Okay, now December 31st, 2020. Guess what? I'm not even going to show you the calculation because it's exactly the same as it was before. December 31st, 2021. So we're continuing to pay the interest on the loan. We're just not paying any of the principal. Now we're at December 31st, 2021. Last day, this is the maturity time period. So what am I going to fork over? Well, I'm going to credit cash, but now I'm going to pay the $8,400 plus the $120,000, right? Because I'm paying 100% of the amount that's owing. So that's $128,400 is how much I'm going to fork over. What am I going to get rid of? Well, sorry, what am I going to get? I got the use of the money for one full year, which is interest expense, $8,400. And I also got back my IOU from the bank because I paid off all of my note payable. So my note payable is no longer payable. I can get rid of it, $120,000. Now you could have done this in two entries, right? You could have said a debit to interest expense 8,400 and a credit to cash 8,400, and then a debit to the note payable of 120 and a credit to the cash of 120,000. If you wanted to do it as two entries, that would be fine because the entries can be combined or separated. But in the end, what's happened is I've not given them any of the $120,000 the whole 5 years that I've had it. All I've done is I've paid interest regularly. Notice that I'm not using compound interest because we're not trying to complicate this. This is just the concept. We're focusing on the concept. So that's what would happen if we decided to only make interest payments. And Manulife One was probably the first entity that decided to offer their customers this type of loan, right? Because the fact is, most people don't want to pay the principal. They just want to pay the interest. And it doesn't help them because they have to pay the same $8,400. That interest never went down. It just stayed at that horrible amount for the whole 5 years. So they were paying the maximum amount of interest because they kept the whole $120,000. But this is available. We can borrow money this way. So how else could we pay down the debt a little bit faster? So here we go. Now we're talking about B. B is where we have a set amount that we're going to pay from the principal. So on January 1st, 2018, Magenta Inc. borrows $120,000 from the bank for a 5-year period at 7% interest rate. Same information. The market rate is 7%. Perfect. So we know it's at par. Magenta has arranged to pay $2,000 per month on the loan. So Magenta is paying $2,000 of the principal of the $120,000. They're paying $2,000 off every single month plus interest on the outstanding principal balance. So how does this differ? What does it look like? And they're paying, are they paying monthly? Yeah, see, $2,000 per month. So they're paying monthly. So now think about it. By the end of the year, they will have paid down 2 times 12. That's $24,000. They won't owe $120,000 anymore. They will only owe, because it's 24 of principal, they will only owe $96,000 at the end of the year. Whereas at the end, and that's at the end of the first year. At the end of the first year, in the first example, they still owed $120,000. But here, because they're going to pay $2,000 per month from the $120,000, by the end of the first year, they will have paid off 2 times 12, like $2,000 times 12, which is $24,000. And that'll mean 96,000 is outstanding at the end of the year. So in this case, we need to do an installment payment schedule. We start with January 1st when we borrow the money. So how much money do we get? We know it's a par loan. So let me just get rid of this. We know it's a par loan. So on January 1st, the balance is $120,000. And that's what we're getting on January 1st. All right. What do we get? We got cash of $120,000. What did we give away? A note payable, an IOU. $120,000. All right. So if we're looking here, $120,000. Now, what happens on February 1st? On February 1st, we're going to pay $2,000 of the principal, right? So we know that this is what we're going to pay of the principal. And after this payment, if I deduct it, I will only owe $118,000. Okay, but the interest expense, I have to calculate that I've had $120,000 for 31 days, 1 month. So $120,000 times the interest rate, which is 7%. And then I'm going to divide that by 12. So how much interest there? $700. So how much total cash am I going to fork over? $2,700. That's what I'm going to fork over. So how do I reflect that on February 1st? Because I got to show the payment on February 1st. Well, on February 1st, 2018, what am I getting? I got the use of some money for a month, and that we know is a debit to interest expense. We know how much interest expense because it shows right here, interest expense, $700. What else did I get? I got a reduction in the amount in the note payable because the note payable goes down by $2,000. So that's going to be a debit to the note payable because I no longer owe them $120,000. I only owe them $118,000 because I paid off $2,000. And then what did I do? Well, I paid over some cash. So that's a credit to cash of $2,700. All right, fast forward to March 1st. On March 1st, what am I going to pay? Well, I'm going to pay $2,000 of the principal because I've said that I'm going to pay $2,000 of the principal every single month. That's going to leave me at the end, sorry, at the first day of March with only 116. But I had the use from February 1st until March 1st, I had the use of $118,000 times 7% divided by 12 months. So what did that cost me? The use of that money cost me $688.98. That's what it cost me in interest. So how much am I going to fork over? $2,688 and 98 cents. That's what I have to pass over to the bank because that's what I owe them. So if I look down here on March 1st, 2018, what do I get? I get the use of somebody else's money for a whole 31 days. That's going to be $688.98. What else do I get? Well, I get a portion of my IOU from the note payable back, $2,000. And then what do I give up? Well, I have to fork over some cash. I have to send cash, $2,688.98 has to be sent to the bank. So let's just do one more month. April 1st, I'm going to pay $2,000, which is going to reduce, right, this down to $114,000. But from March 1st until the last day of March, I had a $116,000 outstanding loan multiplied times 7%, divide it by 12 months because I only used it for 1 month. And that is $676.67. So how much money am I going to fork over to the bank? $2,676.67. And we just keep going down because eventually the principal amount would be zero and I wouldn't be paying anybody anything anymore. And notice my interest expense is declining. It goes down every month. Because every single month I'm reducing the amount of the principal. This stays the same every single month because I've said I'm going to pay $2,000 in principal every single month. Right? That's what I'm saying. And because the interest portion is going down, my payment is going down, right? Notice every single month my payment gets smaller. That's because every single month my principal goes down, so I'm saving on my interest. Let's do that last entry. On April 1st, 2018, that would be a debit to the interest expense, a debit to the note payable because I owe less moving forward, and a credit to cash because I'm going to give the bank money. So this is 676.67, $2,000 less in principal, and I'm going to give the bank $2,676.67. And we would keep going, right? And the interest portion would get smaller and smaller and smaller and smaller and smaller. All right, so this is what I would call fixed principal payments, right? And you can see that right here, fixed principal payments, because every single month we pay the exact same amount of the principal. Okay, so what's the last thing that could happen? The last thing that could happen is blended payments. So what does it look like when we're using blended payments? Get rid of this. So on January 1st, 2018, Magenta Inc. borrows $120,000 from the bank for a 5-year period at 7% interest. So we got the 7% interest. Market rate is 7, so it's on par. Magenta has arranged to make blended payments of $2,376 per month. Payments are made on the first day of every month. Provide all the, the installment payment schedule, and then do the entries. So let's move up. Remember, our payments now are going to be set in stone. I will never pay more than $2,376. Okay. Okay, let's look at this. So on January 1st, remember none of this, because on January 1st, the first thing that happens is we receive $120,000. Okay, fine. So I got $120,000. Oops, forgot to turn my page. Okay, so on February 1st, how much cash do we fork over? $2,376. It's never going to be the same. It's never going to be any different. Every single month, that's the only amount we pay. And this is the mortgage payment that most people are familiar with. All right. So okay, fine. How much interest of that $2,376, how much of that is due to interest? And the fact is, well, we always have to pay interest first. So 120,000 has been outstanding from January 1st to February 1st, multiply it times 7% and divided by 12. And we know $700. Well, it was $700 last month too. It was $700 when we were doing the fixed principal payments. That didn't change because why? Because $120,000 was outstanding for 31 days. That's why. So now, if this is the interest portion of the $2,376, if I subtract the $700 from the $2,376, it will tell me how much principal I paid. And the fact is, I paid principal of $1,676. Right? It's just a difference. If I'm not paying it in interest, then I'm paying down my principal. And I paid down my principal, not by 2,000 like last time when it was a fixed principal amount. No. I'm only paying $1,676. So I can take that away from here, and I only owe $118,324. So now, first of all, let's do the entry on January 1st, because you'll notice the entry on January 1st, no different. Debit cash, credit note payable, $120,000, $120,000. But my entry on February 1st is different. So how much interest do I pay? $700 for using $120,000 for a month. So that's interest expense. $700. How much am I paying down for my principal? I'm only paying $1,676. Why? Because I decided only to have a cash outflow of $2,376 so that I know what my cash outflow is on a monthly basis. So I'm going to credit cash with my set cash outflow of $2,376. Okay, because I wanted to keep my payments at $2,376, I ended not reducing my principal balance as fast, right? So now I'm at March 1st. I want to know how much did it cost me to use $118,324, $118,324 of somebody else's money for the last 31 days, right? From February 1st until March 1st, which is 28 days, but we're just going to pretend they're all even. So this is 118,324 multiplied times the 7% divided by 12. What does it equal? It equals $690.22. So now, how much of this $2,376 is actually going to go towards the principal, to reduce the principal and reduce my future interest costs. I'm going to deduct that, and that's going to equal $1,685.78. That's how much is going to go against my principal, so I can reduce my principal down lower, 116,638.22. So notice what's happening. My interest is going down because my principal is going to go down. And when my interest goes down, my principal payments go up because there's a division. I'm taking the $2,376 and I'm dividing it between two pools. And because my interest pool is going down, it means my principal reduction is going up. So let's do the entry for March 1st. I'm going to have a debit to the interest expense. I'm going to have a debit to the note payable because I'm reducing my principal, and I'm going to have a credit to cash. And notice my cash payments, they're staying the same, $2,376. But the way it's divided, right? I'm paying less interest, 690.22. Notice my interest here and my interest here. I'm paying less interest. Why? Because my principal declined, right? Look, principal went down. So I'm paying less interest. And that means I'm paying more principal, 1685.78. Let's do one last time. From March 1st until April 1st, I had $116,638.22 outstanding. Multiply that times 7%, divided by 12. It's going to tell me what is my interest owed. $680.39. Take that away from the $2,376 that I pay, it's going to tell me how much of my principal is gone. $1,695.61. Again, it's increasing as the interest portion goes down, right? As the interest portion goes down, I've got more money to put towards the principal, and that's going to reduce the principal even faster, which is excellent because I want to reduce the principal as soon as possible because I want to stop paying this loan. So the last payment on April 1st, 2018, I got a debit to the interest expense, debit to the note payable, and a credit to cash. And of course, all these amounts come directly from the chart. 680.39, 1695.61, and this is 2376. All right, so note the three different ways that we can do this. We can do the interest payments only. We can do the set amount to reduce the principal, which was the $2,000. And then we can do these blended payments where the portion that belongs to the principal reduction continues to increase as the interest portion continues to decline. All right, so we only have the bonds left, but we are at 53 minutes. I'm going to save this and then I will start a new video.